Hello there and welcome to another video. This one will be all about the PE ratio. And no, it would not be 10 minutes of theory of what the PE ratio is and why it's used. It's going to be actually about the opposite. Why this so widely used ratio is just being so often misused. If you want to know what the PE ratio is, basically this is all that you need. It's just dividing the share price with the earnings per share. And the reason why I decided to make this video is because there are plenty of conversations online where people make statements that a certain company is cheap or expensive only because the PE ratio is above or below certain value. And I'll argue that that's just not the right way to do it because there are plenty of information that are not included into this ratio. So let's take a look into a few examples. The first one being iRobot, a company that makes robots. And if you take a look at the ratio, it's 20. So PE ratio of 20. How do we get to that? We get the stock price of around $80 per share. The earnings per share is around 4. That's it. And if anyone is being asked, at least someone that has a bit of financial knowledge, what does this mean? The answer would probably be something like this, that it will take us around 20 years to get our investment back, assuming that there is no change in the earnings, no growth or no decline. And there's nothing wrong with this statement. That is correct. But here's what we do not see. The company has 415 million in cash. They can just pay it all out as a special dividend tomorrow. What if that happens? What changes? Well, here's what changes. The company has 415 million less in cash. That will be reflected into the market cap. So the market capitalization would be, in an ideal market, in a rational market, it would decrease, right, for about the same amount, which would bring down the stock price to $64, $65 per share. Now, paying out the excess cash that's not being used for anything would have no impact on the earnings because, well, the company is still doing the same job, will be producing the same robots even without the cash. So the only thing that they might lose is just a little bit of interest, but that's it. So there won't be any significant change when it comes to the earnings per share, yet the PE ratio is going to drop from 20 to 16. So this is a significant change. And if someone is making decisions based on the PE ratio, they might think that this company is expensive. Well, in reality, it might not be the case, but also the other way around. There might be companies that have low PE ratio but a lot of debt. So we should not only look at one side of the balance sheet, but also on the other. In the case of iRobot, there's 47 million of operating leases, so that's not that significant. But there are companies that have a lot more, of course. Let's take a look at another case. What if there's a one-time event that's positive? That, for example, there has been a case where a company benefited because their competitor's factory just had some issue with production and they managed to get a lot of their customers until the competitor fixed the issues. So it was a one-time event. It was positive for the company. They earned a lot more money than they would have otherwise, but it's not sustainable in the long run. So let's assume that this is one of those companies. Take a look at the earnings per share. $3 per share, then there's huge growth, $10 per share. And the PE ratio, of course, drops. So it drops to 6.5. And if someone is investing only because of the low PE, then we cannot say that he or she will get the money back in 6.5 years because the next year it goes back to $3 per share. So making conclusions without knowing more information about the future is just unreasonable. The PE ratio is backward looking. So these ratios that we see here are backwards looking and only for 1 year. And oftentimes there's an argument that they tend to fluctuate around certain level. That's the case until it's not. I mean, there are no rules. No price will fluctuate around a certain level forever, and no earnings, and therefore no PE ratio as well. So don't make, in my opinion, of course, everyone has the right to do what's best, but I would not encourage people to make investments only because of the PE ratio. So just take a look at some other information that are missing in this ratio. But let's take a look at what if the opposite happens. What if there's a one-time negative event? Worst case, in case there's a negative or there's loss, then the P ratio cannot be calculated. But the P ratio can be very high, especially if the earnings are very low. So for every company, there's a point when they were making losses. Then there's a company when they're about to break even, or they break even and it's a very small profit. And in that case, the P ratio is going to be huge because we're dividing with a very small number. So if there's a company that makes millions and their profit is like $10, in theory it can happen, or maybe 100,000, then dividing the price with this 100,000 would give a huge P ratio. Does that mean that the company is expensive? Not necessarily, maybe, but we can't judge that only because of the high P ratio. Maybe their P ratio is going to change significantly because their earnings grow 50 times in a year. And I mean, if your earnings were 10,000, that's a very low amount. So they can grow 5, 10, 20 times. So the P ratio for the next year might significantly decrease. So I want to summarize some of the topics that I've mentioned, what the P ratio doesn't show. And hopefully this makes it a bit more clear, and hopefully it helps some people that are using the P ratio to pay attention to a few more information. So the first one is what is on the balance sheet. I did use one example with having excess cash, but it can be pretty much anything that's on the asset side that even without it, the company will continue with the business operations. For example, if there's land that's not used, if there are buildings, and sometimes we can get this information from the annual report, sometimes not, but the cash for sure is something that we can get. But also, of course, what about the liabilities side? If we have two companies that are identical in any sense, except for the debt, of course, the one that has more debt will have a lower price and therefore a lower P ratio. Now, does that make it a better buy? Maybe, but it's difficult to judge only because of the P ratio is lower. Oftentimes, there are reasons why the P ratio is lower. Then, as number 3, I have outstanding stock options. I didn't cover it before. I do cover it in the valuations, and I think that's important because it has the impact or potential impact to dilute the earnings. For example, if a company is making 1 million and there are 1 million outstanding shares, and we know what the earnings per share is, but in especially young companies, it's often the case that the management is being compensated with stock options as most of their benefits, so that their interest and the interest of the shareholders are aligned. But if the number of shares doubles because of these stock options, it doesn't have to be double, it can be 20, 30% more. That significantly dilutes. So the same earnings would be now distributed to more shareholders, or at least more number of shares. So there might be impact, which has an impact on the P ratio as well. But we do not see this information from the P ratio itself. And lastly, we don't know much about the company. How is it doing? What are the fundamentals? What about the future? Is it going to have higher earnings, lower earnings? What's expected? So we need to see the P ratio as a starting point. I'm fine with that, but we also need to answer questions about these other parts that are equally relevant and even more relevant in many times. And I hope that this made it clear. If you have any questions or comments, please let me know below. And I'll see you in the next one.